Welcome to this week's edition of Noon Knowledge. We're happy to have with us again Justin Lewis, who is the trainer and technical assistant specialist here at People Incorporated Financial Services, and he's located here at the Abingdon office. He is currently pursuing an MBA at Radford, also a graduate of Catawba College, where he studied theater and spent a lot of years at Barter Theater as well before coming to join in the crew here at People Incorporated. He's a well-known favorite here at the Virginia Highland Small Business Incubator, and we're happy to welcome back Justin Lewis.
Thank you, Mark. It's a pleasure to be here. I appreciate you having me and bringing this training to the folks across the region. So I'm just going to dive right in. Today, we are talking about credit and cash flow. Like Mark said, my name is Justin Lewis. My title is the Trainer and Technical Assistant Specialist at People Inc. Financial Services. I'll talk a little bit about who we are and what we do, but we are the Department of Community Economic Development at People Incorporated. Sometimes folks know us through some of our other services and programs. Before we get started, please, if you're on the call currently, please use your real name so that we know who to track and where, who we served, who's learning what and when. And also, if you have any questions that come up during this, 45, 50 minutes that we're going to spend here, put your questions in the chat, in the Q&A box, rather. I'll get to them as I can. And maybe Gene or some of the other folks from the incubator could help me keep track of some of those things. And then throughout this, there will be a lot of ticky-tack little information. So please take notes, write it down, follow up on things. You're always welcome to follow up with me after the training if you have any more questions. All right, let's talk a little bit about People Incorporated. So we are about 61 years old. Last year was our 60th anniversary, and we serve 16 cities and counties as the designated community action agency. We have 30 plus programs. Those programs are in community development, education, childcare. A lot of times people know us through our Head Start centers. Like I said, we are in community economic development. So that's entrepreneurial growth, entrepreneurial development, economic growth, job creation. Some outcomes from our department in particular. I like to direct people to this green banner. It says 3 million in business loans. This is from a couple of years ago. That is capital that we have deployed directly into this community to help people start and grow businesses. These are people who wouldn't have the opportunity through the traditional economic mainstream, but still had great business opportunities, and they've been able to start and grow those businesses. People Inc. Financial Services reaches a good deal beyond those 16 counties where we are the community action agency. We serve 40 counties across the state. You'll see down here in the Southwest, it's 24 counties all the way out to the Kentucky and West Virginia line, up to past Roanoke, the Allegheny and Botetourt counties. And then the rest of them are up in the Shenandoah Valley and what's called the Central Piedmont, Northern Virginia, more or less. All right, let's jump into the training today. First, I am not a financial or legal advisor. Any choice you make, any decision you make going out of this training regarding your finances or your financial situation, those choices are yours. So take with that what you will. You will need to discuss your particular situation with a financial or legal advisor. I am a financial educator. Also, all of the opinions, conclusions, points of view in this training are mine. I wrote this training. They don't represent People Inc. as a whole agency. And then obviously this stuff changes all the time. It's subject to change. It could change tomorrow. So what are we going to talk about today? In this credit and cash flow training, we're going to start with a baseline of your personal credit, how it's scored, how it's reported, so that we can get a good framework and then compare it to how it differs from business credit scoring and reporting. We'll talk about how those intersect, how they talk to each other, especially if you're trying to bridge the gap from the personal to the business. We'll talk about some of the basic business credit products, the forms they take and their uses. And then how do you prepare for taking advantage of business credit if and when it's the time? Let's start with a few myth versus reality quiz questions. I'll give you a few moments to think about the question, and then we'll talk about it a little bit. So the first one is, my personal credit has no impact on my business credit. Is that a myth or is that reality? Yep, that's a myth. Your personal credit has a very large impact on your business's credit at all stages of the business. When I open my business, I'll automatically get credit. That's another myth. Just like personal credit, a business credit record depends on the account. It has to be reported to the appropriate agency. If it's not reported, it doesn't help you build credit, might as well not exist. I can only get business loans from banks or credit unions. That's a myth too. There are other options, including nonprofit lenders, government entities, online lenders. Business credit comes in a lot of shapes and sizes. If I use my debit card to pay for business expenses, it'll show up on my credit report. That's a myth. Debit cards withdraw money from a bank account rather than a credit account, so they don't show up on a credit report. And then finally, all business loans report to the credit reporting agencies. This one's a myth. So all myths. Lenders must determine if and when and where they report those credit products, including loans. We'll talk a little bit more about that later in the training. So let's talk about why credit is important. Many of us have experience on the personal side. With personal credit, it's largely for purposes of wealth building. Things like paying for college, buying a home, making major purchases like automobiles, equipment, boats, major purchases where you don't have the money sitting in your bank account at any given time. You might want to start or grow a business. A lot of times we need to borrow money to invest in our business. It can even affect things like our insurance rates, obviously the borrowing rates on different credit accounts. So these are the ways that most of us interact with credit. And these are important things. I couldn't have gone to college without student loans. Definitely couldn't have bought my home without a mortgage. I'm still paying on that now and probably will be for a couple more decades. On the business side, we may need to invest in or grow our business. It can help us weather the ups and downs of our business, especially in highly seasonal businesses. If you're in retail or if you're in tourism, that's going to have a lean season and a flush season. And credit can help you navigate and smooth out that cash flow while still keeping your business on its feet. It can also even help you win bids, win good contracts, good quality contracts, attract investors to grow your business. Ultimately, credit is a tool. It can help you grow. Too often on the micro and small business side of things across the ecosystem, small business owners are skittish to invest in their business, and that makes a lot of sense. Nobody wants to get out over their skis. But if done patiently and strategically, there can be a right time to invest in your business. There's a cost value proposition that you constantly have to weigh, which is, at what point does the value of the money I'm borrowing outweigh the cost of the money I'm borrowing? That's going to be unique to the situation, to your business, to your personal credit history. But there's no one right answer for every business and every situation. But credit is a tool. It is not wealth itself. It does not extend your budget. It doesn't extend your spending capacity, but it can help you build toward that. So let's start by talking about how personal and business credit intersect. Business credit starts at your personal credit. A lot of times we think of them as two totally separate lanes. because we want to keep our business and personal expenses in totally separate lanes. And this is totally valid. But the credit for your business is going to start with your personal credit, since business credit doesn't materialize out of thin air. So investing in your business, the one you might want to start next year, or in 5 years, or in 10 years, investing in your business starts a lot sooner than you expect. It starts with working on your personal financial and credit standing right now. Your consumer credit reports are details, and we'll talk about what those details are. Commercial reports are summaries. They come in a very different form. Ultimately, what we're looking at is your credit story. The data matters. Facts and figures matter. But if you have a coherent narrative for why things look the way they do, that supports the credit proposal that you're making. Example I like to share is, say you got into a separation or a divorce, your finances were all intertwined for many, many years, and that divorce was 5 years ago, and there were some accounts that were out of your control, that you had no ability to pay off or manage, and your personal credit took a hit on that. Well, that tells a very different credit story from the person who goes chronically delinquent on an account every year. And another example of this is medical records. Somebody who is delinquent on a medical bill that they maybe had already paid and it got reported wrong, or they never knew they had, or it never found their way, or maybe a piece of contact information was entered wrong. That tells a much different credit story from mismanaging accounts. So the credit story is as important as any part of it. So let's look at how personal credit reporting works. This is often called your consumer credit report. What is it? It's the details of your credit history as it's been reported by the lender. It's important to remember, as it's been reported by the lender. This is not objective truth. There's no universal, all credit information is here. It has to be reported in such a way for it to show up on your credit report. If it's not reported, it doesn't exist. So the information that the personal credit report tells us is, it tells us the type of credit that it is. So is it revolving credit? Is it installment? Is it an auto loan? Is it a mortgage? Is it a student loan? How long it's been opened. It will have a start date for that account. And then whether the bills are paid more or less on time. It goes into detail on that for about 24 months. But it will show us whether you pay those bills, those debts, as agreed on time. The personal information that's on your credit report is your personal identification information. So things like your social security number, your date of birth, your name, addresses that you're associated with. Sometimes you'll recognize an address and you're like, oh yeah, I spent that summer in XYZ state. And it'll kind of jog your memory and you'll say, oh yeah, I lived there for a little while. Your account history. So who the creditor is, so the bank, the lending organization that gave it to you, your payment history for 24 months, and the balance. This can be reported a little bit differently sometimes. It might be your average balance. It might be the balance at the time that the credit report was pulled. It'll show your public records. This used to be all public records like child support and tax liens. Since 2018, it is only bankruptcies. So the only public record that shows up on your consumer credit report are bankruptcies. And then inquiries. So this is when a lender or a stakeholder, an interested party, pulls the report to examine it, to review it. There are two kinds of inquiries. There's a hard inquiry and a soft inquiry. A hard inquiry is when you apply for credit. So you go into the auto, Pioneer Chevy or somewhere like that, in an auto lot, and you applied for a loan. You signed, you filled out the form, you signed. The credit card at the department store. You filled out the form, you applied for credit. And then soft is for consumer inquiries. This might be for promotional purposes. The bank that you have credit with, they pull that information so that they can send you a solicitation to say, hey, here's a new credit card we're offering or a promotion we're doing. It's also when you go to review your report as permitted by law. And hard inquiries affect the credit score and that calculation, whereas soft inquiries do not. The inquiry stays on the report for 2 years. After about 12 months, it doesn't really affect the score all that much. Good rule of thumb here, if you're shopping somewhere, you're at the department store or the gas station or the auto lot, don't give your personal information until you're ready to pursue the transaction, until you know that you want to apply for credit. Because once they have that information, they can put in that hard inquiry, and that's going to be on your credit report for the next 2 years. So the reasons you might want to obtain a report for yourself. You're applying for jobs, you're undergoing a big career change, you're moving somewhere new, you're relocating. You want to make a major purchase like a new home or a vehicle. You're going through a divorce or a separation. You're trying to separate your finances and you want to see how things are being reported and what that history is. You might be trying to prevent or ward off identity theft. You may just want to improve your credit or set some goals. You want to start your business 18 months from now, and you review your report so that you know how things are being reported, where you stand, so that you can be working on it toward that goal in 18 months. Maybe you want to be able to get a good loan to go back to school or get a credential. The category that all of these fall into is somebody else is going to be looking at it. So basically, anytime someone else would be looking at your report, you want to know what's on it. Don't let anything take you by surprise. That's the last thing you want, for someone to say, why is this on your credit history or your credit report and you didn't even know it was there. I share an example from my personal life. A couple of Christmases ago, I happened to see on my credit report an address that wasn't mine. It was a Maryland address, and I've never lived in Maryland. And so it was some attempted identity theft. And I was able to dispute that address, get it removed, and say, that's not mine. That's not my data. Can you please remove that? Because the way it works is the fraudsters try to attach, they will attach it to your information and then apply for 500 different lines of credit, different credit cards, things like that. They only need one of them to hit, run it up to its credit limit, and then get out of Dodge. And it leaves the debt there. So that's another reason to review your report. Gene asks, if you have a private loan and are paying it off monthly, will that show up on a credit report? Well, it does depend on who the lender is and how and whether they report. But if it's according to your, if they have pulled and reported your credit, it will show up on the one that they report it to. So an example here, Gene, is here at People Inc. with the loans we give, we pull our credit reports from Equifax, but we report to all three. So our loan would show up on all three of the major bureaus. Gene, it's a loan with a relative, so it's just a friends and family loan. So just it's somebody lent you some money. Is that correct?
Yes, I guess my question is, yeah, if you have a loan with a relative and they don't report it anywhere, how are you building credit, or how can you build credit if it isn't getting reported by that personal friend or relatives? That's what I mean.
Yeah, if it is a friends and family loan, in that case, no, unless, so the report again is as it's been reported by the lender. So if it's not being reported by the lender, it is not an asset to help you build credit. So it might as well not exist to, if you went to the bank and wanted to get a business loan or a mortgage or something. So it does have to be with a lender who reports. That should all be made clear in your promissory note. So the upside of a friend and family loan is it might be more flexible. You can negotiate those terms person to person, but the downside is it's not a credit asset.
If you say like keep a spreadsheet of like starting, loan amount and then paying it off and supply that to a bank that you want to get a future loan, would they even consider that, or is that just kind of
probably? I imagine, I can't speak for them, but I would imagine they would not underwrite off of that. And so a credit report, that's with the three bureaus, and we'll talk about that in just a second. But a credit report is just one factor in a lender's credit matrix. So like your FICO score or your Vantage score, that's just one part of it. That's not everything. So there may be a lender who would take that into account. We wouldn't here at People Inc. Financial Services if somebody says, "Oh, I've made good kind of off the record payments to my cousin Joe for giving me that $20,000 to buy a lawnmower for my lawn care business," for instance. That is not really verifiable, so we wouldn't underwrite off of that. But that's a great question, and one I've never gotten. Great original question, Gene. So the reason this is the something to remember about your reports. Your reports are going to vary based off which bureau you're pulling it from. And the reason this is because each bureau has different subscribers. So different subscribers means they're getting different information. Also, not every creditor reports regularly. So many creditors won't report steady on-time payments. They will only report when it becomes delinquent or goes into default. So things like your rent and your utilities, like I make my utility payment every month. That is credit, but that will only show up on my report if it becomes a delinquency. Important thing to remember about your credit reports: review them and then report and resolve all errors. So if your name is spelled wrong, if there's a former spouse who is listed wrong, if any of the figures like your social security number or your date of birth, if there are duplicate accounts or unauthorized inquiries, dispute those, get them removed, because it can create problems down the road. I spoke about the fraud earlier. That's an example of it, but it's a lot of data and it has to be managed, and they get it wrong. Especially if you're a junior or a senior, or you have the exact same name as somebody who was born in the exact same year, they can get tied to the wrong person unintentionally. So review and report, dispute and report and resolve all errors. The place you go to do this, not the disputes, but to pull the reports, is annualcreditreport.com. This is the official site. It's the real one. It's not getcredithereorelse.org. It's not freecreditnow.edu. It's annualcreditreport.com. So you are entitled by law once every 12 months to pull a report from each of the three bureaus for your review. These don't count against your credit score. They don't look like a hard inquiry. They are for informational purposes. Since fall of 2023, the three bureaus have determined that their clients perform better by giving them continued access to their reports. So they've made it their just internal policy, not required by law, that you can review it once per week. Who knows how long that'll happen, but they obviously derive some benefit from that. So you can go and review your credit report basically as much as you need. There are three major credit bureaus. There's Experian, TransUnion, and Equifax. The reason the reports are going to be different, I spoke to this a little bit different, is with the different subscribers, they all have different data. So I use the example of we report to all three, but we pull from Equifax. So if you have something in your credit history that isn't reported to Equifax, we don't see it. We can't see it. So that's something to consider. Sometimes you'll go in and you'll say your report will look different when you go to this auto lot to that auto lot. Well, it's because this one subscribes to the Experian Auto 4 and that other one subscribes to the Equifax Auto 7. Those are different reports. So they have different data on them. Let's look at an example. This is just a sample to add another joker in the deck. Each of the bureaus structures their reports a little bit differently. They're fairly easy to navigate, but this example leads off with personal information. So your name, your social security number, addresses, and then it goes into public records right there at the front. So they had in this example, a bankruptcy that was discharged within the last 10 years is how long bankruptcies show up on your report. Then it has a little key for this is what the reports that you're about to see look like. And then this one leads off with potentially negative accounts. These are the ones that are dinging your score and taking it down, and this one puts them right at the front. Sometimes they're arranged chronologically. Sometimes they might be structured more like this. So this one you can see, it shows you the balance at $400, and it shows you the date that it was opened, and it shows you the status that this one was charged off. So this went delinquent so long that the creditor charged it off of their books. They said, we're never going to be able to collect this. And so you can even see where that happened. So they paid okay for about a year and a half, or about a little over a year. And then they went 30 days, 60 days, 90 days, and then 120 days delinquent. Here, I'm going to get the laser pointer right here. And then at 120 days, the creditor, big bank in home state, whatever, charged it off and said, well, okay, that is a dead account to us. And they either sent it to collections or sold it to a third-party collections agency, something like that. There are a few examples of that in here. And then this one has accounts that are currently in collections. So these are whether it's in-house collections at the lender or a third-party collection agency. And then the accounts in good standing. So you can see they opened a revolving account. So it's a credit card a little over a year ago, and they've stayed in good standing that whole time. $1,000 credit limit, details like that. A couple of examples like that, and then they show you the inquiries. So they call them regular inquiries. So that means hard. That means you applied for credit these 2 times at this credit union and then at this auto lender. And then the account review inquiries, or the soft ones. So you can see there's lots of these. So about once a month, big bank pulls their credit report to review it, probably to manage their portfolio, whether they should upgrade or downgrade the account. And then there's some more right here. And then the last page in this sample is messages. This is where it would show up that you had a credit freeze or a credit alert, something like that, any special messages. So that is a personal credit report. The ideal candidate, when you're going out for personal credit, has 3 to 4 revolving accounts, revolving meaning something like a credit card or a line of credit, with really high limits and really low balances. Basically, they want to see you have a lot of credit that you're not using. There's this thing in the credit world called credit utilization. They never want to see you exceed 30% of your total, what's called global credit utility. So you have $10,000 in total global credit. They never want to see you use more than $3,000 of that at any given time. They want to see you have at least 1 travel or entertainment credit card. The reason this is because those are stricter cards. These are like airline cards or rental cars or sometimes dining. These are more strict rewards cards in the travel and entertainment credit card industry. All trade lines, and trade line means any money you've borrowed. They call that a trade line on your consumer report. They're at least 6 months old, but ideally more than 3 years. So they want to see you have credit and manage it for a long time. So if your credit is really young, let it age. Best practice here, don't close out lines of credit that you no longer need. Keep them open, just don't use them. Use them only enough to keep them awake or alive. If you have to use it once every 6 months, use it that one time every 6 months, pay it off, don't carry any interest on it, just to keep it open and alive. No derogatory items of any kind, no missed payments, no penalty fees. Few inquiries. Obviously, everybody has to apply for credit, but they don't want to see you credit shop. So 1 to 3 times in 6 months, so a couple times a year if you go out and you need to buy a new car, you need to get a personal loan, something like that. You're going out, you're shopping for homes, and you went out and saw what you could get for your mortgage. You just don't want to go out every month and apply for credit. And then at least 1 installment trade line. So as opposed to revolving, they want to see you make steady installment payments over time. So things like an auto loan, a mortgage, a personal loan, student loans are installment trade lines, that you've made that steady payment and satisfied the terms of the loan over the life of it. So all of this data from your consumer credit report is calculated into your credit score. So that's where that data is pulled from. Your credit score is the calculated risk of loaning you money expressed as a numerical value. So they're trying to say, how likely are you to repay expressed as a number? That number ranges from 300 to 850 in the consumer credit world, depending on which bureau you're using and which scoring model they're using. The industry standard is called FICO. You hear this in ads and stuff, your FICO score. They're very old. They go back to the 1950s. They became the industry standard in the 90s. They do have a competitor called Vantage Score that's much younger. They were established in 2006. And you see more and more places use it, especially in the mortgage industry. I think one of my credit cards uses Vantage Score. Things to remember about a credit score: it is a snapshot of your creditworthiness in that moment. That means it is constantly in flux. As the data changes, the score changes. So that ebb and flow is a natural part of the credit score. Also, there are many, many different credit scores. A lot of times you'll hear people say, oh, that's my credit score. Well, there isn't just one. The reason this is because your credit score is calculated for that credit product you're trying to get by that lender or that bureau, that scoring model. So to use the example of the auto lots again, that auto lot subscribes to the Equifax Auto 4. They like that because it aligns with their credit matrix, their risk appetite. So that's the one they like to use. If you go and apply for a mortgage, that's going to be a TransUnion Mortgage 8. That's calculated totally different based off the needs of that credit product. So they're going to weight it differently. They're going to factor that. So the data in is more or less the same because it's from your credit report, but the scoring model changes based on what the credit product is that you're trying to get. So that's why your credit score can be different from place to place. Gene, my Discover card gives me every month my FICO score. Does that show up on a credit report as a soft inquiry? Most likely, yes. When I go on my credit report, it'll show this bank pulled my credit like once a month, and that's how often my Chase card updates it or whatever. And yes, that does show up as an informational or soft inquiry. So FICO and Vantage don't really, they do calculate their scores a little bit differently, but the underlying principles remain the same. We'll use FICO as the example because they're kind of the industry standard. 35% of that score is your payment history. So that's the biggest factor. Do you pay on time? Do you pay as agreed? More recent actions factor more heavily. So a missed payment last month matters more than a missed payment 2 years ago. Next, right behind that, also very important, the amount you owe. Are the balances, do you already have a lot of balances on your credit currently? So do you owe, do you have $1 million in loans? It also is relative to your credit limit. So, you've got a $1,000 credit limit on this card. Do you have $800 on it or $200? The length of your credit history. So like we talked about, you want it to be old. So what they'll typically do is take your oldest account and your newest account and then average them. You want them ideally to be older than 6 months. The smallest factors are credit mix. So do you manage revolving credit, installment? Do you have a mortgage? Do you have an auto loan? They want to see you manage a good variety of credit. The best practice here, don't take out unnecessary debt just to improve this factor of your score. It's a pretty small factor all told. It's only 10%. But if there's an organic way to improve that credit mix, that's probably, take advantage of that. And then finally, new credit, also a fairly small factor. This is primarily only a negative factor. Do you have a whole bunch of new credit? Have you been out credit shopping? So the reasons you have a low score are, there's nothing surprising on this list. It mostly falls into the category of you didn't pay as agreed. So serious delinquency or serious delinquency that led to a bankruptcy. A delinquent public record like your unpaid child support or unpaid taxes. Those are the reasons. The typical reasons. Another one further down the list, the proportion of balances to credit limits. You've ran all your credit limits up. You've maxed out all your credit cards, basically. There are things that do not and cannot go into your FICO score. Your race, your color, your religion. Demographic information is not permitted to be factored into the FICO score. Your age, your salary, how much money you make, your title. They're not in your FICO score. It doesn't mean that they won't necessarily be in, the lender won't take it into account. So you walk into a bank, you want to apply for an auto loan. On the first line, they say, how much do you make per year? So the lender wants to know, but it's not in your FICO score. Where you live, the interest rate on the other accounts, you'll see in the sample report we looked at, there was no, the interest rate was nowhere on there. Your rent is typically not factored into your FICO score. Things like your child and family support, if you pay these on time, you're just expected to pay them. They are not a credit asset. Unless delinquent. Anything that goes delinquent will likely be reported, but you're just expected to pay these on time regardless. Your non-credit banking information, so your deposit accounts, how much money you have in checking or savings, they're not in your FICO score. And then those promotional inquiries, those consumer disclosures that Gene was asking about, those are not in the score. They're just on the report. So people say, what is a good credit score? It's a range. Again, it's going to depend on what you're applying for, how much you're trying to get, where you're trying to get it from, because different lenders, banks are in competition with each other. So they're all going to have a different appetite. You want it to be as high as possible is the rule of thumb. So the range is 300 to 850. So if you're up towards 750 to 800, you're in great. You're up talking about super prime. Into the 700s, you're talking about prime, and then down 650 to 700, you're starting to talk about near prime, and then below 650, you're starting to talk about subprime. The higher the better, typically, but there's no one cutoff. There's no one universal cutoff. It depends on the lender. Let's take a moment to talk about delinquency and credit rehabilitation. Important thing to remember here is that positive action equals improved score. So this whole time we've been saying data in, data out, period, full stop. It's not like diet and exercise where you say, is this working? If you take positive steps, it will improve, period, full stop. There's no emotion to it at all. But what that also means is you can only build it or improve it or rehabilitate it through active trade lines. They have to be alive, current, and turned into a positive asset. So this speaks to Gene's question about the friends and family loan. That's not an active trade line because it's not being reported. So the life cycle of debt here is you have your active in good standing. So this is current on-time accounts. This is healthy debt. This is a credit card that you keep current. This is your auto loan that you pay on time. It's also any account that has been paid off to satisfaction. It has matured within the last 10 years. So you paid off your car 6 years ago. It's sitting there as a positive account. Next is late but active. So this means you're behind. Late can mean different things depending on different lenders. The important thing about these is that they can be made current. If you paid it off and brought it current, it would move back up into that green category and it would be active in good standing. It's important to revive these before they're what's called charged off, because that's the last category. Charge-offs, it's been sent to collections, it's now a public record, maybe they sued you for it. These can never be made active again. So they are going to be a charge-off forever. All they can do is age, and time does lessen the impact. They're not, the full weight of that is not going to be felt forever. But once it's in this category, it can't be undone. So it's important to revive these things before they get charged off. So that affects your timeline when you're looking at credit rehabilitation. So by law, your date of first delinquency is 30 days from when it became late. That date of first delinquency sets the timeline for your credit report, and that account, that delinquency shows for 7 years from that date of first delinquency. So it became delinquent in September of 2022. 7 years from September 2022 is how long it will appear on your credit report. That date does not change unless you bring it current again and then become delinquent again a different time, but that's a different delinquency. That date, the date of first delinquency, never changes. This is different from the statute of limitations. That's how long the creditor has to sue you for the debt. The timeline of the statute of limitations varies by state and depending on the credit product. In Virginia, it's 3 to 6 years, depending on the type of credit. The statute of limitations can be reset. So if you acknowledge the debt, you start making payments on it, you call and do a workout and say, okay, well, I'll pay a little bit on it. That can reset the statute of limitations, which again is how long they have to sue you. It does not change the date of first delinquency. A couple of exceptions to this timeline. I mentioned bankruptcies appear for 10 years. A tool that you have for your credit reporting and scoring are credit alerts and freezes. Alerts are where whenever somebody applies for credit, they get in touch with you directly and say, hey, Justin, somebody just applied for an auto loan in Abingdon, Virginia. Was that you? And I say, yes, that was me. Let that go through. A freeze is where nobody can apply for credit at all, including me. So even if I tried, it blocks them out. So if I want to go to apply for credit, what I have to do is go in and lift that freeze for a period of time, apply for credit in that window, and then that freeze will go back on. You do have rights here. So the lender must inform you every time you apply for credit within 30 days, whether you were accepted, declined, or ruled incomplete, and they must tell you why. Also, the Fair Credit Reporting Act is what legislates how this information is obtained, stored, shared. And it's also is what legislates your right to access and correct those reports. So now let's start talking about how personal and business intersects now that we have a baseline of how the personal works. So your personal credit history is attached to your Social Security number. Your business credit is attached to your employer identification number, which is your registration with the IRS as a business entity. Most business loans require a personal guarantee. So this is a legal promise that you will repay the business's credit accounts if the business stops making those payments. So SBA guarantee loans, they require for anyone owning 20% or more of the business. We ask for a personal guarantee on our business loan. So it is a business loan, but we ask for a personal guarantee. So you are personally guaranteeing that note. The guarantor doesn't always have to be the owner. It can be a co-signer. It can be a third-party guarantor, depending on the policies of the lender. If you're a nonprofit, it may be the treasurer or a board member. And then businesses or business credit products may or may not appear on a report. So it depends on the loan product and the institution. So even with a personal guarantee, it may or may not show on your personal credit report. Because for example, I've worked with clients, they got a commercial loan on a commercial property to run their business. It had a personal guarantee, but it didn't show on their personal credit report because that specific bank's policies, they didn't find the value. It wasn't worth the cost to report that to consumer credit because it was a business credit product. So remember, only actively reported accounts can build your credit. So the differences here, so business credit has no regulatory standards or really fewer regulatory standards. This means that there are no free reports. So I said your consumer credit report, you're entitled to that one free one a year. There's no such thing in business credit reporting. Also, the delinquency timelines are set entirely by the lender. Those are not mandated by law. In consumer, it's mandated to be 30 days. With business credit, it might be 1 day. It might be 5 days. It might be one billing cycle. Depends on the lender. These scores and models in the business credit world are proprietary. They are a service that it's a pay service that you subscribe to and you participate in. And so that's another thing it's not free. It's not free to report or pull. It is that's all pay service. The principles still apply. Pay on time, pay as agreed. So when you're looking at your business credit reporting, these are called commercial reports. So we had our consumer reports, and we had our commercial reports. The places that provide commercial reports, the one people hear about a lot is D&B or Dun & Bradstreet, but Experian and Equifax also provide commercial credit reports. TransUnion does not. They choose not to participate in that market. They focus on consumer credit reports. These range roughly from 0 to 100, the scoring. So for Dun & Bradstreet, it's called your Paydex score. Equifax calls it their Business Payment Index. Experian calls it Credit Ranking IntelliScore. Each agency has its own criteria for what it takes to qualify for a score. So the number of trade lines you have, the length of your history. These also credit reports, business credit reports and scores cost money. It is a pay service. So if you're small and you're having to keep your budget very lean, you may want to pick and choose your investment based on what your timeline is. You may want to subscribe for a certain period of time that you have a goal. You say, okay, well, I'm going to want to invest in XYZ in 12 months. So I'll pay for the service for here so that I can see where I stand and see where it is and how I can improve it. And then I'll not pay for it for a while. It's going to depend on your business. Also, business credit reports can be viewed for any reason by anybody who's willing to pay the fee. So there are regulations on that in the consumer reporting world. In the business credit report world, since it's a pay service, they just pay for it or they don't. There's something called your DUNS number, DUNS. That's your Data Universal Number System. So this is your unique ID with Dun & Bradstreet. I point this out because you'll need that if you want a Dun & Bradstreet score, but you used to need it to get government contracts. That's no longer the case. The government contracting systems now uses what's called your UEI, or Unique Entity Identifier. But I point that out because your DUNS number used to be essential for government contracting. It is no longer the case. And the reports in your business credit world are summaries rather than specifics. So let's talk a little bit about that. Your report, your business credit report, is going to have your business's identification information, your business's credit history, but it's a summary, not a specific. So this is not going to include the name of the lender or the vendor. So your line of credit at Office Depot, for instance, may just show up as Office Supply Store. Payment history is the key component of your credit history here. Rather than regulated delinquency reports, they'll use a term called slow pay, which might mean that you're past due, might mean that you're delinquent, might mean you're habitually a slow pay. They also may report your balance, the amount of the credit you have, the due dates. That's all determined by that particular credit reporting agency. There's no industry standard. Your legal or your public records. So in the consumer reports, it's bankruptcies only. But in business credit, this is also going to be tax liens, judgments, collections, and also any UCC filings. So that's Uniform Commercial Code. So that's basically liens on your business assets. Good due diligence for business lenders is they're going to file a UCC lien for every loan they give, just so they're on the record. We do that. It's not that we're going to collect on those assets. It's that we want to show up on the record as a lender to this business. And then your business credit inquiries. So this is the number of times a creditor or an interested party viewed your business credit report. Again, hard inquiries are going to be when you applied, and softer are going to be pre-approvals, account monitoring, things like that. Inquiries in the business credit report world, they vary based on, again, on the agency. Good rule of thumb here is too many inquiries is a red flag. You're having to go out and apply for credit all the time. The things that are not on it, your personal information, your personal credit accounts, your business's financial statements, like your profit and loss, your balance sheet, and your business banking information. Underwriters will still want to see that stuff. They'll go through line by line with your bank statements, but not your business credit report. Let's take a little overview on the business credit products that you can get. So there are 500,000 business-to-business vendors in the US. Only 10,000 of them report to a bureau. So that's something to factor in if you're looking to build or establish business credit. Factor that in. Jean asks, if I had a business under one name with great credit, but closed that business and opened another similar business 6 months later under a different name, would the business credit start all over? If it has a different business entity, Jean, yes. So it is, it's kind of like if it was tied to your social security number, it wouldn't carry over to somebody else. If it's a different business entity, yeah, it would have its own credit history. So products, business credit cards, vendor credit, business loans, and lines of credit. Let's look at these in an ascending scale from your cheapest capital to your most expensive. First one is term loans. These are available at banks, credit unions, community lenders like your revolving loan funds. These also include SBA guarantee loans. So these are loans that are backed by the SBA so that a lender can kind of take more risk. They have a pretty narrow application criteria. Term loans are going to be best for large purchases like property, startup and expansion expenses, projects that won't be paid until the end of the contract. Important principle here, match the term of the loan to the purpose. You don't want to be paying for inventory that's only going to make you money for 6 months for 5 years. You don't want to be paying for that for 5 years because it didn't earn you any money. So that's why larger purchases over time are a better fit for term loans. Then you have lines of credit. So lines of credit have a draw period and a repayment period. The draw period might be years, but that means basically how long you can pull cash from that account. And then once the repayment period locks in, that's a set repayment term. So once that locks in, you have 3 years at this term to pay it in. There's typically with a line of credit, there's no grace period the way there is with a credit card. Usually interest starts accruing the day of the transaction. These are best utilized by large volume inventory or supply heavy businesses that have short turns. So you buy inventory, you collect on it before the end of a billing cycle so that you can satisfy the terms of that without paying anything for that capital, more or less. Then you have vendor credit. So this is where the person, the food supplier, the inventory place that you buy from, they supply the credit directly. There are 2 types of vendor credit. There's invoicing, where at the end of the month or the end of the billing cycle, they settle up, this is what you used, and then you have 15, 30, 45 days to pay it. So common at auto shops, you have your parts that you bought for your customers, you settle up at the end of the month, and then you pay that within whatever that turnaround time is. And then you may also finance with the vendor. So this is for equipment. You go down to the Kubota place and you buy a big piece of excavation equipment and you financed it through the vendor. These are good for establishing long-term relationships. You have a face-to-face relationship with somebody in the community, and you can build a long relationship that can benefit your business in the long term, but they're less likely to report to the bureaus because they're smaller, they may not be able to afford it, it may not be worth their time because it costs them to report. So there's a give and a take here. And then credit cards. These can be store cards, vendor cards, corporate cards, your just standard business credit card that you see commercials for. These are going to be good for regular cyclical expenses, things like registrations, memberships, your parking fees. You have a membership at the Chamber of Commerce in your area. It goes on your credit card. You have the capital to do it, but you just don't want it to chase down that invoice. You settle it up at the end of the month before you collect any interest. These are often a good way to build business credit, to establish it. You can start showing some history over time without taking on a whole lot of debt. And used correctly, used correctly at taking advantage of the grace period on a credit card, it can be a short-term, low-cost, or free loan to yourself to help you manage cash flow. So it's not that you didn't have the capital for it. It's that you were going to have to make 8 tiny purchases in a 2-week window. And instead you made them, they went on the credit card, you paid it, you satisfied that statement before any interest collected on it. Any of these can be secured or unsecured. And remember that your business assets are considered weak collateral, typically to the lender. So you're going to say, oh, well, I have all this equipment. What does it cost the lender to collect on that? They're going to have to go acquire it, resell it, auction it off. How much are they really going to make? So they are going to value it at a much lower value than it is valuable to you. So there's this concept of emotional equity. So emotional because you're connected to it. You have a vested interest. You don't want to lose your classic car. You don't want to lose your business assets, for instance. It doesn't have a whole lot of real world value, but it gets buy-in from the borrower. And remember that you can't use credit for all expenses. Your tax liabilities can't be paid with credit. Certain vendors can only take wire transfers, for instance. So there are a few examples of that. I'll try to be finish up expeditiously, but also thoroughly. So the places you look for business credit, your first stop is your banks and your credit unions, but also your vendors, your suppliers. Do they offer credit of some kind? We use the example of office supply. If that's a regular monthly expense, that might be a good place to look for it as well. There are also nonprofit and community lenders, places like CDFIs, that's us, Community Development Financial Institutions. There might be places, your EDAs and IDAs, or your locality has a revolving loan fund that they might manage. That might be a place where your business could borrow. And then licensed and reputable online lenders. I use this as an example of not every online lender is created the same. Not every lender is created the same. But just because it's convenient and accessible does not always mean it's a smart choice for you in that moment. So make sure you're borrowing from a legit lender. If they say, we don't pull your credit at all, well, why is that? And remember, that can't be turned into an asset either. So questions to ask yourself when you're looking at business credit. Am I ready? Your business structure is formalized and it's registered with the State Corporation Commission. You have your articles of organization or incorporation. You have a regular cash flow, regular and clear business expenses. You kind of know what your turn is over the course of a billing cycle. Inventory costs, your rent, your ongoing purchases. You also have plans to grow or expand. You always want to take on debt to invest. You don't want to take on debt for revenue. And then you have the capacity to take on and satisfy a new account. You can make all of your existing payments and the new payments. What you'll need to prepare when you go to look for business credit: be prepared to provide your bank statements, your monthly income and expenses, especially on the personal side. A lot of times that global debt service coverage is what gets a business loan over the hump. Your business debt to income ratio. What's your debt schedule? How much are you borrowing? When will it be paid off? Your cash flow projections, 12 to 14 months typically, up to 5 years. Best practice, you want to do it through stability. How long will it take for the business to pay for itself? Your business has financial statements like your profit and loss, your balance sheet. Your registration paperwork, so your federal EIN, your city and county licensing. Your organizational documents, like your operating agreements, your partnership agreements, your bylaws, and then a business plan. Oh, and then your business plan. So make sure your business plan is a living document. The hardest one to write is going to be your first one. And then after that, you adapt it to the needs of your business in that moment. There are signs that you might not be ready. Your business is still an idea. It doesn't have structure yet. It's not formalized. You haven't built your separate bank accounts. You haven't registered. A lot of times it's not that your business never needs an influx of capital. It's that you borrowed at the wrong time. Your business doesn't currently have the cash flow to repay. You can't borrow your way into revenue. Your business must fundamentally pay for itself. You might need to improve your personal credit first. Remember, your business credit starts at your personal credit. So be working on that, and maybe you'll be ready to borrow in 12, 18, 24 months. Business doesn't have structure. It doesn't have your licensing, your insurance, your personal and your business expenses are entangled. You have disqualifying liabilities like tax liabilities or federal student loans, delinquent federal student loans, or unpaid child support. The answer to these questions doesn't have to be no. It can be not yet, because you could be ready sometime in the future. These are all solvable issues. Before we go, I do want to make a little note about fintech or financial technology. These are flexible, convenient financial tools that are online. They're the buy now, pay later apps. They're online short-term lenders. These are not a universally, it's not a universally bad decision every time. What I will say is know what you're buying. We have seen some otherwise excellently run businesses say, oh, wow, that's so accessible. They want to provide that $20,000 loan to me. The world of fintech is so new that it is not as well regulated as a lot of your traditional lenders. So fee disclosure is not always clear. The fraud and identity theft protections are not always in place. How it's affecting your credit. Can you pay it off ahead of time? Can you make prepayment on that loan, or are they going to charge you for it fully capitalized? So proceed with caution is what I'll say about fintech. So best practices when you're looking at credit, always have a plan to repay, not just the intention to pay, but a plan. Borrow for investment, not for revenue. No amount of borrowing can fix an upside down business operation. Have it before you need it. And then keep your business and your personal as separate as you can. Business credit is not a way to sidestep scrutiny of your personal credit until your business has a long credit history of its own, which takes time, can be done. But you want to keep them as separate as you can, but know that they'll talk to each other. So to finish this out, talk a little bit about what we do here at People Inc. Financial Services. We're what's called a CDFI. That's a network of independent nonprofits across the country that all act according to their own missions, their own policies toward economic empowerment and entrepreneurial development and job creation. So we are a mission-driven lender. What does that mean? We're a nonprofit, we're grant funded, we are intermediaries for funds to deliver into this community. We are ultimately a Department of Community Economic Development. That's our underlying goal. Our lending products can be more flexible than the highly regulated, strict credit matrices of banks. So we can look at the loan proposal holistically. We can think outside the box. We work in partnership with everybody, with the incubator here today, but also with our fellow banks, communities, other support agencies. And then we provide things like this: training, technical assistance, help people build the skills to not just build and start their small businesses, but help them thrive. Our financial products, here's a little breakdown of them. Point to the business loans there because that's what we've talked about today. If you need capital and for whatever reason you're not a fit with the bank, we're your next stop. All right. Thanks for letting me run over by about 7 minutes. For the folks hosting here today, do you have any questions of things I didn't cover before we go?
I think you were extremely thorough, as always, Justin, and we appreciate you so much helping us with these new knowledge sessions and with our business challenge as well. And we have recorded this.
So anybody out there who's watching today, whether you're watching it later or now, here's my contact information on the bottom of the screen. If you have questions about what we talked about today, or just questions about your businesses and how we can help you develop the skills to help your business succeed, or if you have questions about capital, always happy to answer those. So hand it back over to you all. I appreciate you having me.
You again, Justin.
Well, thank you, Justin, and we appreciate all that you do for us here as well as People Incorporated. Y'all do great work in the community and the region, and we appreciate that. So thanks again.